At a time when news about the political and economic outlook seems to arrive hourly, it's important to step back sometimes and not lose sight of the big picture. And globally, that big picture has darkened. The world risks slipping into a low-growth, low-inflation rut caused by deep structural forces, limited policy space, and growing concerns about the fracturing of the global trading system. Over the past 18 months, global growth has slowed markedly, business investment has been weak, and trade has contracted. Many of these dynamics occurred first in the United Kingdom, particularly the heavy drag on business investment from entrenched uncertainties over future trading arrangements. Now it's become possible that the picture in the UK could change, with the recent UK-EU withdrawal agreement creating the prospects for a pickup in UK growth. The pace of that recovery will depend critically on the extent to which uncertainty over the future UK-EU trading relationship actually dissipates, and to a much lesser degree by how much the global economy actually picks up. Both are assumed in the MPC's latest projections. Neither is assured. In this context, and with inflationary pressures weak globally and contained domestically, monetary policy will need to be carefully calibrated to support a sustainable recovery. Let me expand a bit on the global outlook. The world economy has moved down from a broad-based expansion to a widespread slowdown, with growth decelerating from around 4% 2 years ago to 2.9% at present. The world economy is now expanding at its slowest pace since the end of 2009. Trade-related uncertainties are clearly weighing on global activity. Global trade has been falling since late 2018. Both the global manufacturing PMI and new export orders remain in contractionary territory, and the global services PMI is now softening as well. Investment growth has fallen, accounting for most of the slowing in GDP growth in both advanced and emerging economies. The headwinds from elevated uncertainty are likely pushing down on the global equilibrium interest rate, exacerbating concerns about limited monetary policy space. In the MPC's latest projections, global growth remains subdued in the near term, consistent with significant protectionism and growing concerns over the reordering of the rules of global commerce. Against those structural headwinds, the recent material easing in monetary policies and financial conditions in most major economies is projected to support a gradual recovery in global growth to around potential rates by the end of the MPC's forecast period. Turning to the UK, the underlying pace of growth has slowed below potential, and the economy is now operating with a small margin of excess supply. Quarterly GDP growth is expected to average just 0.2% this year, about half its pace in recent years. Subdued UK growth partly reflects the weaker external backdrop that I just described, which is weighing on both net trade and investment in this country. But as has been the case for some time, Brexit uncertainties are dominating, weighing particularly hard on business investment, which unusually during an expansion has contracted in 5 of the past 6 quarters and is currently estimated to be just 0.5% higher than at the time of the referendum. Consumer spending has proven more resilient to Brexit uncertainties, growing steadily in recent quarters, underpinned by strong employment and a pickup in wage growth. However, there is now evidence of a degree of precautionary behavior, with the latest data revealing that household savings rate has drifted up since the start of 2018. Moreover, uncertainty has weighed on the housing market, and recent data suggests that the labor market could be beginning to soften. Employment growth contracted by 0.2% in the 3 months to August, the weakest outturn since May 2015. The number of vacancies has been falling continuously since the start of the year. The REC demand for staff index is at its lowest level since January 2012, and indicators of pay growth from the agents and the REC have also fallen back. Turning to the withdrawal agreement and its potential implications, the MPC projects that growth is likely to remain a little below potential in the near term, but will pick up thereafter. That upturn in growth is underpinned by a judgment that the Brexit uncertainties facing businesses and households will decline gradually over the forecast period. The MPC's standard practice is to condition its projections on government policy. Accordingly, our November projections are conditioned on an orderly transition to a deep free trade agreement consistent with the aims of the political declaration between the UK and the EU. Although the details of that new trading relationship are still to be determined, the withdrawal agreement and a flexible extension to 31st of January have probably reduced some of the uncertainties facing businesses and households, not least by lowering the perceived risks of no deal significantly. The fall in the perceived likelihood of no-deal Brexit has also led to an appreciation of sterling, which has risen by around 4% over the past 3 months. In our projections, the assumed reduction in Brexit-related uncertainties supports activity. In particular, four-quarter business investment growth picks up materially from current negative rates to around 4.5% by the end of the forecast period. That's the fastest pace since the referendum, and it recoups around 1/3 of the estimated investment shortfall since that vote. Household consumption rises broadly in line with real income growth over the forecast period as a whole, also picking up, in this case from 1% currently to 1.5% in 2020 and 2% by 2022. Demand in the UK is also supported by the gradual recovery in global growth and a boost from UK fiscal policy reflecting the planned increase in spending announced by the Chancellor in his 2019 spending round. Note that these projections are conditioned on the current market path for interest rates, which is consistent with bank rate being below its current level through 2022. The extent of the pickup in UK growth is likely to be limited by continued weakness in growth in the supply capacity of the economy. Potential supply growth is projected to remain subdued relative to historical rates, averaging around 1.25% over the forecast period. That reflects a continuation of the post-crisis trend, as well as the impact of the UK transitioning to its new trading relationship with the EU. Consistent with the provisions of the withdrawal agreement, the MPC's latest projections are now conditioned on the assumption that a greater proportion of the adjustment to the UK's new trading arrangements with the EU take place within the 3-year forecast period, whereas previously the MPC's projections had been conditioned on a stylized assumption of a smooth transition to an average of possible end states, with the adjustment taking place over many years. Overall, the support from lower uncertainty, easier fiscal policy, and stronger external demand has a result that UK growth is projected to pick up from around 1% this year to 1.6% in 2020, 1.8% in 2021, and 2.1% in 2022. So it picks up throughout each year of the forecast. In the committee's projections, excess demand emerges in 2021 and builds over the remainder of the forecast period, reaching a sizable 1.25% of potential by the end. The MPC judges that the risks around its projections for potential supply growth, and therefore GDP growth, are skewed to the downside in the second and third years of the forecast, reflecting the uncertainty around the exact nature of the FTA with the EU and the transition to it. Turning to inflation, it has been close to target recently. It's expected to decline to around 1.25% by the spring, owing largely to temporary effects of falls in regulated energy and water prices. While unit labor costs have been growing above target consistent rates and core services inflation has begun to increase somewhat, employment growth has slowed and pay growth is likely to fall back in the near term. In the second half of our forecast, however, as a significant margin of excess demand builds, domestic inflationary pressures are expected to build as well. Conditioned on current market yields, CPI inflation is projected to rise to 2% in the second year of our forecast and slightly above that towards the end of it. Let me conclude by turning back to the bigger picture and to policy. For most of the period following the EU referendum, the degree of slack in the UK economy has been falling and global growth had been relatively strong. More recently, Brexit uncertainties and slower global growth have led to the reemergence of a small margin of excess supply in the UK economy. In the MPC's projections, we expect both of these recent trends to reverse. For now, that's an expectation, not a certainty. If global growth fails to stabilize, or if Brexit uncertainties remain entrenched, monetary policy may need to reinforce the expected recovery in UK GDP growth and inflation. Further ahead, provided these risks do not materialize, and the economy recovers broadly in line with the MPC's latest projections, some modest tightening of policy at a gradual pace and to a limited extent may be needed to maintain inflation sustainably at target. At this meeting, the MPC judged that the current stance of monetary policy is appropriate. But however events unfold, it shouldn't come as news that the MPC will set monetary policy consistent with a sustainable return of inflation to its 2% target. And with that, Dave, Ben, and I would be pleased to take your questions.